Welcome everyone to Shell's 2025 Capital Markets Day. I'm Mohammed Hamid, Executive Vice President for Investor Relations and Strategic Planning. It's wonderful to see so many familiar faces in the audience and some new ones as well, and a warm welcome to those of you who are joining the live stream online. I'll start by outlining the run of the day. First, our CEO, Wael Sawan, and our CFO, Sinead Gorman, will kick off with an overview of the Shell investment case, followed by a Q&A. After that, we'll have a short break, and when we come back, Wael and Sinead will take a deeper look at our businesses, followed by another Q&A session. And then for those of you who are here with us in New York, we will be joined by some key business leaders who we have in the audience with us today. But before we get started on some of the content, please note the cautionary statement behind me on screen, and I know many of you are familiar with this. It's also available in full online. And before Wael and Sinead begin, we'd like to take a moment to play a short video that nicely summarizes our journey to date. For those of you who are more familiar with the Shell story, you'll notice a phrase, and some would call it a promise, from the past that will be key to our journey going forward. And with that, let's play the video. Thank you.
There's a global company that's connected energy to people for over a century, delivering on a lasting promise. You can be sure of Shell. Innovation, it's been in our DNA from day one. Through pioneering technology, we've made energizing the world our business. Commissioning the first oil tanker passing through the Suez Canal. Fueling the first ever transatlantic flight. Delivering the first shipment of liquefied natural gas by sea. And helping to guide the first astronauts to the moon. Providing new forms of reliable energy to a growing customer base. With pride, passion, and commitment. And through challenging times, Shell has always been there for its customers, keeping them moving, keeping them warm, keeping them bright. But that's only part of our story. Today, we are a world-leading integrated energy company, serving 33 million retail customers, over 1 million businesses in more than 70 countries. We're constantly evolving and innovating, delivering on our strategy and commitments, guided by our principles of performance, discipline, and simplification. Strengthening our portfolio and capabilities to realize our potential for our people, customers, partners, and shareholders. So as the world changes and your needs evolve, we'll deliver more value with less emissions and keep our promise, just as we have done for over a century. You can be sure of Shell.
Thank you very much, Mohammed, and welcome everyone to our 2025 Capital Markets Day. It's great to see so many of you here in the room in New York Stock Exchange, and also a warm welcome to all of you joining us today online. As Mohammed alluded to, the video uses a phrase that many will have heard before. You can be sure of Shell. That phrase has been used in different ways over the years, but it nicely encompasses what we've been trying to do, to restore and to bring life across this organization. So what do we mean by that? Well, it comes down to confidence. Confidence that we will create even more value for our shareholders while reducing emissions. Confidence that through performance, discipline, and simplification, we will deliver what we say. And confidence that we are strongly positioning Shell for the future, resilient irrespective of how the energy system evolves. Now let's go back to Capital Markets Day 2023, or CMD 23. We knew we had an organization of great people and some world-class businesses, but we also knew there were questions on our consistency, our focus, and our ability to unlock Shell's potential. And we agreed with that. So we moved with urgency and conviction. We decided to course correct, challenge internal dogmas, while undertaking a cultural reset. And that correction spanned multiple areas. We sought to drive improved performance, embed cost and capital discipline, and make fundamental decisions across our portfolio. We sought to transform the company. And whilst there is much more to do, we are proud of where we are today, having taken the difficult steps when we needed to. The from and the to are clear. We reduced the number of targets significantly, ensuring that the ones that we did set were purposeful and would instill focus across the organization. We also introduced the principles of performance, discipline, and simplification, and as we proceed to the next phase of our journey, they will remain our guiding principles. These are major changes which require significant efforts, especially by our staff. I could not be more proud of how they are rising to these challenges and how they are enabling our transformation, helping us deliver the successes that we have enjoyed so far. I'm also pleased to see our collective efforts reflected in our shares outperforming peers and at the same time helping to drive our lowest net debt in nearly a decade, which positions us well for all scenarios. This gives us the momentum to keep improving and to deliver even more for our staff and our shareholders as we continue on our journey to deliver more value with less emissions. At CMD 23, another area we touched on was our desire to build a track record and earn back the trust of our shareholders. Our mantra of delivering on what we say we will do has permeated throughout the organization. By simplifying our processes and standards to help debureaucratize the organization, together with setting up more frequent performance cadence and much tighter management of capital, we are seeing real improvement, which is visible across all of our key targets. In fact, if you look to the left on the slide, you will see that we are over-delivering. This is particularly impressive in the areas of structural cost reductions. We had a target of $2 to $3 billion by end of 2025, and as we stand here in March, we have already exceeded this. On shareholder distributions, we said we would distribute 30 to 40% of our CFFO through the cycle, and we've delivered above that. And it's not just the more value side that we've made progress on. On the emissions side, earlier this year, we reached our target of eliminating routine flaring. We also achieved a reduction in the net carbon intensity of the products that we sell, moving us closer to our target of a 15 to 20% reduction by 2030. In 2024, we introduced an ambition to reduce customer emissions from the use of our oil products by 15 to 20% by 2030, and I can confirm that we are progressing well on that too. Hopefully what you can all see is that when we say we will do something, we deliver. And I hope that as a result, when you walk away today, you have the same high conviction that we do, that we will deliver on what we have said. And we've learned a lot over the last 2 years, and these lessons will serve us extremely well over the next period of our transformation. We are clearer on where we want to go as a company, where we should play, and where we need to step back, and how to help our people and businesses unlock their full potential. As we think through how to measure that potential, our North Star remains free cash flow per share growth, and alongside this, as we outline in the second part of the presentation, we aim to enhance our capital, aiming for a ROACE greater than 10% across our segments in a normalized $70 per barrel oil price environment. We're extending our free cash flow per share growth target of greater than 10% per annum out to 2030, and believe that this continues to be a good proxy for intrinsic value creation. Alongside these long-term and more fundamental principles, today we're also outlining the next phase of our transformation, with 2028 representing a key milestone year for Shell. we're raising our structural cost savings target to a cumulative $5 to $7 billion by the end of 2028 compared with 2022. We're further right-sizing our cash capex to $20 to $22 billion per year from $22 to $25 billion. And we will continue to reward investors with higher distributions, moving our payout percentage from 30 to 40% to 40 to 50% of CFFO through the cycle. So in summary, we're going further on all of our financial targets, building on the strong foundations that we have built during Sprint 1. Let me step back now for a moment. Shell has connected energy and people for 100 years now. It's what we do and what we will continue to do. And while we can't always predict the future of energy, our scenarios help set the bookends of possible outcomes and inform our portfolio choices. Whether it's our archipelago scenario, which reflects a worldview which is very much focused on owning resources or tighter border and trade security, not too dissimilar to what we are seeing today, or our recently published surge scenario, which incorporates increased demand from AI into the energy system. One message is consistent: demand for energy will continue to grow. Across all of these scenarios, we see gas, and in particular LNG, being a winner, and that's aligned with our portfolio today, and our longer-term vision, which I will come to in the next slide. We expect that supplying LNG will be the biggest contribution we will make to the energy transition over the next decade, and we are positioning our portfolio to match this. At the same time, continued investment in oil will be needed to offset the natural decline rates of oil fields. Aligned with our vision to sustain a material liquids production base, we are ready to take advantage of the growth opportunities ahead. And as the demand for secure and affordable energy rises, it will need to be consumed with lower emissions. Lower carbon molecules and renewable power will play an important role supporting the decarbonization of the different sectors. EV share will grow in light transport. Biofuel demand will grow in heavy transport and in aviation, together with the increased use of natural gas as marine fuel. All these are foundations for maturing a set of high-quality, low-carbon business options, which we will talk about later. Ultimately, different outcomes and different rates of change across energy vectors are possible, but we believe that Shell's strength comes from a portfolio and balance sheet that aligns with the uncertainty of a transitioning multi-energy system. Now, before delving deeper into our plans through to 2030 and the beliefs that underpin them, I want to lay out our longer-term vision to ensure that our investors are clear what they are getting into when they buy the Shell investment case. The vision we have is underpinned by the positions that we have created today. From the strength of our balance sheet that you'll hear more about from Sinead in a moment, to our strong free cash flow delivery that we will grow further, to the momentum that we have in sustaining the successful Sprint performance improvement journey that you have seen, I am confident in our future path. That path is about three great franchise businesses that drive our conviction in growing free cash flow, and all three are core to our portfolio. Through our intent to fully fund growth across all of these, our investors can be sure of reaping the rewards of resilient and highly attractive shareholder distributions through not just cycles, but decades. First, in integrated gas, or IG. We are already the #1 global listed LNG supplier, and we intend to remain a leading integrated gas and LNG player through to the 2040s. We believe LNG will be one of the most durable energy vectors through the energy transition, with very attractive growth prospects. We will aim to decarbonize our gas value chains and, over time, strive to develop and commercialize lower carbon intensity gases. Second, we are today the #1 global lubricant supplier and a world-leading mobility platform, but we aim to be the most customer-focused energy marketer and trader through to the 2040s. Our trading capabilities are one of our most important competitive advantages, and they add immense value to our portfolio, especially through the mobility short. We expect this value uplift, which is already material in products and integrated gas, to expand over time and help unlock new growth opportunities through deeper integration with our power, mobility, and low-carbon options. And third, we will sustain material liquids production as we expect demand to fall less than natural field declines. We will focus on basins where we have a competitive advantage and will prioritize cost and carbon competitive molecules which add and high grade our leading deep water and conventional oil portfolio. I hope you'll agree that we are shaping a winning portfolio for the future, one that offers our investors a differentiated investment case with underlying resilience and attractive distributions. Our portfolio today is more streamlined than it has been for years, but we still have work to do to truly enable us to realize our full potential. Let me introduce a frame which we will use throughout the rest of the presentation to outline our plans across our portfolio. On the one hand, we have world-leading businesses offering focused growth across integrated gas, mobility, and lubricants, and we also benefit from adjusted earnings and cash flow stability and resilience within our upstream and products businesses. Combined, these represent around 80% of group capital employed and generated an attractive 15% return on capital employed last year. We will continue to allocate capital towards these businesses and are confident that they will provide cash flow duration well into the next decade, which is far beyond current market expectations. On the other hand, we have businesses where we are focusing our attention to unlock value and realize upside. Those are chemicals, power, and our low-carbon options, including low-carbon fuels, hydrogen, and CCS. Combined, these constitute the other 20% of the group's capital employed, but in aggregate, they are not delivering adequate returns. Our plan is to further high-grade returns in this portfolio and implement the business models and structures that will unlock the most value. Our overall investment case consists of three distinct characteristics. We offer upside price exposure through our IG and upstream businesses. We offer downside price protection from our resilient downstream businesses. And thirdly, best-in-class volatility capture through our world-leading trading capabilities. Let me now expand on these three to explain why we believe we have a portfolio that offers both focused growth and duration. Firstly, in LNG, we aim to grow volumes within our overall LNG portfolio at a 4 to 5% compound annual growth rate to 2030, which, as you will see later, is largely Brent exposed. And across our combined IG and upstream businesses, we also aim to grow top-line production by 1% CAGR to 2030, supported by 1.4 million barrels per day of liquids with a clear value over volume lens. We don't believe these growth elements and the resulting cash flow longevity, which extend well into the next decade, are fully appreciated today, but we are confident in their delivery. The second key characteristic of our portfolio is the downside protection as well as the longevity offered by our downstream businesses, including chemicals and products and marketing, and eventually our low-carbon options. While cash flows from our core IG and upstream businesses bring a certain degree of commodity-linked volatility, these downstream businesses offer very stable adjusted earnings and CFFO, even with external volatility. Lastly, given the commodity and margin volatility that we expect will continue to be a feature of energy markets, we are better positioned than most to capture further value through our unparalleled trading and supply capabilities. The uplift that this provides will continue to bolster and enhance our cash flow delivery, from which our shareholders will also benefit. We don't often speak about our trading and supply capabilities, but our scale and our global footprint are unparalleled across the industry. We've been developing these capabilities and positions for decades, which makes them hard to replicate, as the map of our global assets highlights. As a result, trading has shown consistency in performance, resulting in tangible value creation, delivering an average uplift of around 2% to our return on average capital employed over the past decade. Indeed, across this time, we have not lost money across our commodity classes in any quarter. This is an underappreciated and undervalued aspect of Shell that is fundamental to the integrated nature of the company. And looking ahead, we expect our trading and supply capabilities to continue to contribute 2 to 4% return on capital employed uplift. This uplift is possible because our scale in energy markets is just unmatched. We have the largest LNG capacity amongst our peers and one of the world's largest LNG shipping fleets, representing 10% of the global market. Beyond LNG, we trade more than 8 million barrels of crude daily. And in 2024, we physically traded more than 10 billion liters of low-carbon fuels. With hundreds of supply points worldwide, this portfolio represents one of the largest energy trading capabilities globally. Now, let me hand over to Sinead to detail how we plan to unlock even more value for our shareholders. Sinead.
Thank you. Let me first start with where we have come from. The first slide that Wael spoke to is one that makes me smile and makes me proud of everything the organization has delivered. We have sought to ensure that every capital allocation decision we take is in service of creating long-term value for our shareholders. At Capital Markets Day 2023, we stood here and outlined a revamped approach to how we allocate capital, with a conscious focus on increasing per share value. We went from the myriad of targets that Wael mentioned to an emphasis on free cash flow per share. Our conviction then and our conviction now is that our shares remain undervalued, which the middle chart demonstrates very nicely. This presents the management team with an opportunity to undertake buybacks at an attractive price relative to our underlying cash flows, and with the full knowledge that there's much more we have to deliver. And we've been building momentum. We went from a 20 to 30% payout to 30 to 40%, and that has translated into tangible results. Over the last 3 years, we have bought back more than 20% of our shares and also increased our DPS by 25%. Combined, this has helped us deliver peer-leading total shareholder returns. And today, with confidence in our path forward, we are further increasing our payout to 40 to 50% of CFFO through the cycle. We continue to see significant free cash flow opportunities across our portfolio and material upside in our shares, which is why we continue to preferentially allocate capital to share buybacks. By 2030, with our share price at these levels, we see the potential to repurchase up to a further 40% of our shares. For a company that has had a flat share count over the last 20 years of the century, our delivery since 2022 and our plans through to 2030 represent one of the most significant shifts in capital allocation in our history. Staying with the theme of capital allocation, let me outline our plans for cash capex. We remain committed to making every dollar count, being unemotional with our spend and delivering performance, not just promises. So despite inflationary pressures, we are today lowering our cash capex range from $22 to $25 billion per year to $20 to $22 billion for 25 to 28. This is about raising the bar for investment. It's about being strict and allocating more to the highest returning projects we have. And it's about a disciplined approach to creating low-carbon options for the future. We expect to spend around $12 to $14 billion a year in integrated gas and upstream, both of which will continue to contribute significantly to cash flows and allow us to sustain our material liquids production and grow our LNG sales. In downstream and renewables and energy solutions, we aim to spend around $8 billion a year. In renewables and energy solutions, we will take a measured approach, building positions to deliver cash flows in areas where we can leverage our strength, such as our trading capabilities. And as we've previously indicated, our cash CapEx guidance includes a small amount of capital for bolt-on inorganic activities, and that will continue to be the case. We exclude other inorganic activity from our range, but would expect those, if they arise, to be directed towards integrated gas and upstream, in line with our strategy. Given the discipline that we have shown and will continue to exercise, we are driving improvement in return on average capital employed across all our businesses. By 2030, this will mean a shift in capital employed towards the higher returning businesses that Wael described earlier. With that, let me move on to structural cost reductions. In 2023 and 2024, the delivery across the organization has been excellent, helping us to reach our reduction target of $2 to $3 billion for structural costs 1 year ahead of plan. The majority of these savings in 2024 came from non-portfolio activities. For example, we now have a leaner corporate center, which helped us save some $700 million, including a reduction in the number of contractors by around 30% since 2023. And outside of the corporate center, at the front line, our staff are starting to spend every dollar as if it were their own. As an example, travel costs have come down some 40% compared with where we were 5 years ago. For Wael now, it's an important barometer of cultural change. We are transforming Shell. Our people have stepped up and are at the forefront of this transformation. As our ways of working change and our ability to challenge paradigms increases, we continue to identify ways to go even further. We're moving at pace to realize these opportunities, which is why today we are upgrading our structural cost reduction target to a cumulative $5 to $7 billion by the end of 2028 from 2022. This is about putting our principles of performance, discipline, and simplification to work, streamlining processes, and being purposeful in everything we do. The majority of the savings will come from non-portfolio activities. We see opportunities to further optimize our procurement and supply chains. We're excited by the latest technology and AI opportunities, which will help us become even more efficient. And we will continue to identify opportunities to simplify further in the corporate center. All of these will ensure we remain agile and competitive, and we will not stop looking for further cost savings beyond this target. One of our key priorities when embarking upon our first sprint was repositioning the portfolio, and we've certainly been busy. There's a lot on this slide, but we wanted to highlight the key strategic decisions that we have taken since we were last here. On Singapore, we moved from strategic review to divestment at pace, with the transaction expected to complete next week. We announced, signed, and recently completed the divestment of SPDC, which has been an overhang on our stock for some time. We showed cultural change in action by pausing HEFA, responding to a changing context, making a difficult decision with a project in flight, which is something we have not done enough of in our history. And finally, we showed a willingness to challenge long-held positions, such as our presence in the North Sea, whilst exercising both agility and creativity in announcing a new JV, which will leave the combined entity better off than the status quo. We used the phrase pragmatic in our approach, dynamic in our response at CMD 23. And we hope, as we stand here today at CMD 25, that you can certainly see this in action, and you should expect much more to come. So moving from the positioning of the portfolio to the positioning of our balance sheet. We stand here from a position of strength, which we have worked really hard to create over a number of years. In fact, we have one of the strongest balance sheets amongst our peers, and the strongest we have had in nearly a decade. Excluding leases, our net debt at the end of 2024 was around $10 billion, with gearing at 5%. Despite the progress we have made, we remain committed to maintaining a strong investment-grade rating through the cycle, reinforcing the financial strength that underpins our long-term strategy. So as Wael mentioned earlier, we have delivered on our free cash flow growth targets, and we remain confident that with our portfolio and performance focus, free cash flow will continue to grow through 2030. We will further outline how we will achieve this when we delve into the respective businesses in the next section. Our dividend remains a financial priority, and our confidence in sustaining a progressive approach is well supported, with our dividend break-even at around $40 per barrel. Additionally, given that we view share buybacks as an attractive use of our cash, we will continue to allocate capital towards buybacks, even at $50 per barrel world, utilizing our balance sheet strength if necessary. We have been clear that free cash flow per share is the key financial target for the company. At CMD 23, we introduced a target of free cash flow per share growth of greater than 10% per annum to 2025. And today, we're extending this target to 2030 as we drive intrinsic value creation. This is relative to 2024, based on organic free cash flow before working capital and derivatives, and at a $70 per barrel Brent price in real terms. We have exercised discipline and focus to enable us to reach this position. And although we are pleased with where we are, we're not done yet. So let me tie this all together and outline the rest of our financial framework. A progressive dividend growing 4% annually, cash capex spend of $20 to $22 billion allocated towards higher returning businesses, payout percentage increased to 40 to 50% of CFFO, preferentially allocating towards buybacks, all whilst maintaining a strong investment-grade rating. As I said in 2023, we take our responsibility as custodians of our shareholders' capital extremely seriously. We believe in pragmatism and balance, allocating capital based on value. We remain confident in our path forward and free cash flow generation. So in summary, a strong balance sheet and a strong portfolio means a stronger Shell, and that is good for investors. With that, I'll hand back to Wael.
Thank you, Sinead. At CMD 23, we set out 4 financial targets, and we clarified our 4 carbon targets during the energy transition strategy in 2024. We've met the financial targets, and we are on solid footing to achieve our carbon targets and ambition. So today, we leave our carbon targets unchanged while stretching the financial ones further. We're extending our target for free cash flow per share growth of more than 10% per year through to 2030. We're increasing our structural cost reductions to $5 to $7 billion by the end of 2028, lowering our capital spend to $20 to $22 billion a year from 2025 to 2028, and increasing our shareholder distributions to 40 to 50% of CFFO through the cycle. We've come to the end of the first part of our presentation. Now, before we go to Q&A, let me summarize our position. We're creating a portfolio that is built to win, that delivers more value with less emissions, that allocates capital and carbon with discipline and a value focus, that accelerates delivery through performance, discipline, and simplification, and that rewards shareholders with consistent, competitive, and resilient returns. We'll do this profitably for our shareholders, delivering both high returns on capital and high returns of capital. Thank you for your confidence and for your support. Mohammed, back to you.
All right, thanks, Wael. Before we start, we'd really appreciate it if you could stick to sort of 1 to 2 questions each to allow for as much time as possible. And please do state your name and firm. Hands are already going up, which is great. But yeah, with that, let's start. I'll try and cover the room, and there are some online as well. Why don't we start here at the front? We've got a few. Let's go with Biraj first.
Hi, thanks for the presentation. It's Biraj Borkhataria, RBC. The slide that kind of stuck out to me was slide 10, where you addressing head-on 20% of your capital employed is basically not generating adequate returns or negative returns in this case. And I'm assuming there's different answers to rectify that issue across the segments that you've outlined. But could you just walk us through in a bit more detail, how you expect the path to go from -2% ROCE in those segments to a more adequate return? And then the second question is just on kind of market perception. So you've been on this journey since CMD 23. Sprint 1, you could argue, is quite successful. Shares have outperformed the peers, but largely due to the earnings performance rather than the multiple. So as you're thinking about the journey going forwards, is it now the time to start thinking about doing something more radical in terms of value unlock, or is that more of a discussion for a few years down the line as you develop this track record? Thank you.
Thank you for that, Biraj. I think your first question, and correct me if I'm wrong, Sinead, we will cover in a lot of detail when we go into the second phase. So we will go, Biraj, plan by plan on chemicals, power, and then some of the low carbon options like LCF, hydrogen, and CCS. So if you don't mind, let me park that and we'll come back to it. And if you feel that we haven't fully addressed it, we can come back in the second set of questions. On your second question around where we feel we are at the moment, I think firstly, we came here almost 18 months ago, 19 months ago, to be able to tell the story and to be able to re-earn confidence. And I do think we stand here today in a much better place, having indeed built up a consistent track record of delivery, having out-delivered on the promises we made, and having the momentum to be able to accelerate our strategy as the next version of the story. As you touched on, whether it is measured on TSR improvement, which is some 30%, or whether it's on share performance, we have outperformed our peers, but we haven't fundamentally re-rated, right? At the end of the day, what we are focused on is very much what are the sequence of actions we need to take to be able to achieve the outcomes. We've taken the first set of actions. Today, you'll hear a bit more about what we're doing for that 20%, including chemicals, et cetera. You've seen us continue to revise upwards from 20 to 30%, all the way up to 40 to 50% our distributions. We are confident as a result of that we will continue to move in the right direction. And what you will see is that we will continue to focus on unlocking value for our shareholders through that sequencing of decisions that we are taking. And so while all that's happening, the one big arbitrage opportunity that we are able to play for the benefit of life cycle returns for our shareholders is buybacks. And hopefully what you've heard today, with a 40 to 50% CFFO, the preferential allocation will continue to be to go after those buybacks, as Sinead said, with an ambition to be able to continue to grow that towards the potentially 40% of shares being purchased over the next 5-6 years.
Okay. Shall we take a question there, Kelly, at the front with Lydia, please?
Thank you. It's Lydia Rainforth from Barclays. Two questions if I could. Shore of Shell. It's probably 20 years since I've heard that phrase actually used. So can you just talk about the confidence level that you have to actually go back and use that, and how much support there is internally actually for that? And then secondly, just coming back to the cash flow side of it, I think it was slide 11 where you have that really interesting chart of the longevity from integrated gas and marketing actually growing into next decade and sustaining. And ultimately, that looks like it covers where your CapEx level is today. But is that part of what gives you confidence around that 40 to 50% number, being able to sustain that longer term and potentially more?
I can come back to the first one. Did you want to start with the second one?
Sure. No, indeed. And thank you, Lydia. And the only thing I will say, it's really nice to be able to say with confidence, you can be sure in Shell. It has a resonation across the organization. In terms of the cash flows, you're right. So on that chart, what we're trying to show you is the different parts of our business. So of course, we have upside potential without a doubt in terms of price, and you see that through our upstream and integrated gas businesses. But what you see and why we put marketing and IG together was exactly that growth potential. So the IG, our integrated gas business, through our belief in terms of LNG sales, you see that 4 to 5% coming through. But also marketing, and what you'll hear a little bit more about later, is really about how we intend to generate even more cash flows from those businesses. So you hear us talk about premium, et cetera, and where we expect to go there. But those combined actually add sort of that growth story for the company. There's much more to the growth story, and we can take that through and unlock it a little bit more as we proceed. But there is that confidence. Beyond that, of course, is the growth that we see in terms of upstream as well. So when you put upstream and integrated gas together, you end up with a 1% production growth, CAGR, through to 2030. And that's really well backstopped by projects, which we'll delve into the specific projects and where we see the break-evens of those coming up.
Thanks, Sinead. On the You Can Be Sure Shell, I think if I step back for a moment, Lydia, what are the winning characteristics of a company in our sector? Firstly, consistency of delivery and distributions. Secondly, resilience through the cycle to the energy transition. And thirdly, disciplined capital allocation and making the right calls even when the macro is challenged. Right? So that You Can Be Sure of Shell for us, from an investor lens, is making sure that we're playing across these. But you're exactly right. To broaden You Can Be Sure of Shell, it starts with the confidence that our customers have to buy our products. It starts with our staff, our people, who hopefully many are watching today. There's a spring in their step. And I have to acknowledge it's been hard, right? Because we are changing a very big company. I still remember walking off the stage after CMD 23 and no one asking me about the content, but saying to me, the monster is going to consume you guys. You won't be able to deliver what you're saying. This is a testament to them and what they've been able to do over the years. And once we have that spring in the step, that's why we can start to move forward. And so the You Can Be Sure of Shell for me is, yes, confidence, but importantly with humility. Because the world is uncertain, and what we need to be able to do is to focus on what's in front of us, what we can control, and to build that confidence through the good and the bad times, and to be able to have a team that's hungry to win and to be able to hold on to that mantra as for well into the future.
Right. Shall we take the table at the back there? Paul? I'll come to you.
Thank you. Paul Chan, Scotiabank. We're just curious that, comparing to your peers, they are targeting to grow their liquid production. You guys is looking to stay flat for the next several years. Is it a function of your view on the global oil market, or that is more opportunity or organizational capability limit that to make you make that decision? And what kind of reserve replacement target that you have? The second question, if we look at throughout, I think one big thing for you and Sinead is that simplification and make it more efficient organization. Can you give us some example? Are we talking about cutting off some of the layer? With your recent announcement in the management change, you actually have two heads for integrated gas and upstream instead of one head before. So we're just trying to understand that, how that reconcile in terms of simplification and make it more efficient. Thank you.
Thank you very much. Let me take the second question if you want to address then the liquids one. The blessing and the curse of being a 115-year-old company with an incredible portfolio is that over time, you allow bureaucracy and complexity to creep into the organization. And a big part of the sprint was to just call it out and start to be able to declutter that. The couple of points you touched on there. One around how we are structured, I think, organizationally. Zoe and Hybrid have made a huge contribution to getting us to where we are today. What we have announced recently is that colleagues who were reporting into them have essentially moved up. So we have delayered the organization. Because in this step of the journey, what we want is much shorter lines of communication. We're doing the same, by the way, with our capital allocation, where one of the biggest things you should take away from today's presentation is A, performance going further, and two, an appetite by this management team to go after capital reallocation in favor of unlocking healthier returns out of every dollar we are employing. And so we are moving the role of capital allocation squarely to Sinead and myself with the support of the incoming executive committee to really get much tighter on a much more frequent cadence around this. Those are some of the bigger examples of simplification. Sinead touched on things like travel and the like, how we've been able to just do work in different ways. But there are multiple examples. I do these recognition calls on a regular basis, and one that sort of came through recently from legal, for example. We do thousands of non-disclosure agreements, all requiring a lawyer to prepare. Through one of our business operations in Krakow and Poland, we have now developed essentially a risk-based NDA, where some 85 to 90% of our NDAs, you can press a button and have them without talking to a lawyer, and 10 to 15% require or get escalated to a lawyer because of the context. There are 20 of those examples, and we can talk about them in the break. The point being, every single one of these is now starting to come bottom up, and that to me is the sign of culture change.
Thank you. Apologies, you're going to have to wait until I do the oil one. Paul, your first one was really around our views on the global oil markets, et cetera, and why our liquids production, you commented on, is flat. So what I'd remind you of is we very much believe in the need for oil and gas for decades and decades to come, but specifically on oil, which is what you're referring to here. So our liquids production, what we're looking to do is, of course, ensure we maintain or sustain that very material levels going out. What you'll see as we talk through in the next section is we'll talk into a little bit more detail on it. We'll talk about the fact that whilst we have very attractive businesses, there is a decline rate to that, and we will continue to invest to be able to have that materiality going through. There is no cap. That's not what we're suggesting on that. We're basically just simply giving you a view out to 2030, which is not priced in at the moment. So I think that's very important because I don't see you pricing that in. So that's showing you that we will be able to maintain all the way through to 2030. It's not about organizational capability or anything else. It's purely about our focus on ensuring that we backstop out to 2030 and show you line of sight to 2035, which will be the next discussion. You also alluded to sort of the reserves replacement targets. You've heard me say this before, I don't have a target. What I care about more is how I make money out of this stuff, and therefore it's very much focused in terms of the high margin barrels that will come through. We'll spend a little bit of time on it in the second section where you'll see some of the numbers and our thinking around that, which is why I'm not going to go into more detail now.
All right, we'll show some love to this side of the room. Michele's got his hand up at the front here.
Michele Della Vigna from Goldman Sachs. Congratulations on the very strong delivery since the last Capital Markets Day. I wanted to ask you really one question in two parts. We see two big discrepancies in valuation. On one side, the issue of some of the parts. For instance, your marketing business could easily trade on 10 times EV/EBITDA. As Shell, you trade between 3 and 4. And then the other big discrepancy is US versus European valuation. I was wondering, clearly you're doing everything you can to improve the quality of the business, the resilience, and the profitability. But at some point, do these discrepancies come to the point where something needs to be done? And on one side, for instance, for marketing, I'm thinking, do the synergies with the rest of the business justify keeping a business that could be so valuable on a standalone basis? And on the other side, I think also the issue of relocation, clearly very complex, very difficult to execute, but at some point, if that valuation gap really doesn't close year after year with improvement in returns, is there something that needs to be considered?
Given this is one question, two parts, do you want to kick off and then I can supplement?
Does that mean I get to go in either direction?
Anywhere you want to go.
Ooh, this is good. So in terms of, I'll give you the relocation one, because I think that's more suited for the CEO at the moment. The marketing business, so per your point, let's just take it back to what's the principle. Our overriding principle is about creating intrinsic value, you know that. That's exactly what's on our mind. There are no sacred cows in this company. We look at exactly where we can realize value across all parts of it. And you see it, whether that's, going after things in the North Sea, which has been, core to our heart. We are in the North Sea, and yet we're creating a joint venture. But we saw an opportunity. We saw an opportunity to partner with somebody else to create value. So when you talk about our marketing business, and we'll spend some time on it later, which I realize I keep dancing back to later on these, what we're doing there is focusing in on improving the underlying. So improving the actual performance of that, and I hope you see that. I think there's some team here who'll be able to answer some of the detail for you at the table as well. But what they are doing is actually driving improved ROACEs across that business, and it's coming through. They're really delivering each and every day on that. We see a huge amount of integration for our marketing business. It creates a short, and I think Wael talked about that a little bit in the speech as well. So our trading business is able to maximize value. And frankly, what we see is an awful lot of the trading houses trying to buy into some of these, whereas we have that integrated chain. I'll leave you to do the US.
Yeah, thank you, Sinead. Michele, thank you for that, for the question. Let's step back, right? So where were we in 2023? At the end of the day, I have to trust that the market is going to value a share in the right way. We have a very comfortable proportion of US investors in the Shell share, right? So we went back to fundamentals. That's what we believe in. The fundamentals said at 20 to 30%, we weren't distributing sufficiently, and we were inconsistent in our delivery. So the sprint was a compressed 10-quarter window to really just re-earn that confidence around the consistency and the competitiveness. And so we addressed one part of it, but we're not done. Right? The other part that we still need to do is to continue to improve that competitiveness, but it is important to recognize that the longevity question has been a big question, and that's what we want to also try to dispel today. Right? You've seen the first part of dispelling it, which is the IG, the marketing growth. You'll see a bit more, as Sinead's already alluded to, around the underlying liquids growth. I would very much like, when you walk out of the room today, to have line of sight, not to 2028 only, but to 2040. This is what this company is building. It's building for the decades ahead, not for the next couple of years ahead. In addition to that, we are looking to build resilience, because we're quick to forget the difficult times. Today, we are still in a very healthy macro overall. And so we want to build the resilience that gives us the ability to navigate, whether it's through buybacks at $50 or potentially counter-cyclical moves. That's what we're playing this game for the long run, not trying to sort of get a sugar rush for our share price in the short term. That's not what we're doing. What you can be assured of is the following. We are always going to look at opportunities to unlock more value for our shareholders, and we will be very deliberate and methodical in the way we're going to sequence our moves to make sure that we are pushing the right buttons at the right points in time, so that over the coming few years, we truly are able to realize the value that sits within our portfolio.
Okay. Over here, Roger.
Thank you. Roger Reed, Wells Fargo. The 2 to 4% uplift in trading returns, we've come off a pretty volatile last few years, so 2% and volatility, generally speaking, helps that business. What should we be looking for over the next, say to 28 or 2030 to get to the 4%? Has there been a restraint on this business that's being released? Is it a function of increased LNG or more electricity trading? I'm just curious how you get there, and then how you think about the risks that you need to manage in putting a larger trading target out.
Yeah. So our trading capability is core, Roger. You're right. It's something that differentiates us and has been able to allow us to extract value compared to many others. What we did was actually give you a 10-year look back, which is why we gave you the sort of greater than 2%. If we'd gone, obviously, to closer years with the volatility, it would have been much higher. And that's why we went longer. We're trying to give you that long-term view, as Wael said, to be able to build through decades here. Our trading business is core to what we do as a capability rather than a business. It manages to use the assets from our different business leaders here. And of course, one of the things that Wael has done is to bring trading up to his executive committee so that he has line of sight, he has that ability to be able to optimize across it, which means they'll be much more integrated in everything that we do. What do we really need to do? We need to get out of their way and allow them to be able to actually focus in on where they can create different value. We have strong constraints around them in terms of the sandbox that they operate on. This is not freedom to do whatever they wish to do. Be very clear on that. It's very much about ensuring that they understand the liquidity, the impact on the group, and the volatility that comes with them. But it's a dialogue. And that's where having Andrew sitting at the table with us, being able to have that discussion, allows us just to unlock. We're very much focused. You see it in our leases, actually. We have a higher amount of leases than, frankly, any others of our peers, and that is because of our trading business. It's in service of our trading capability. Why do we allow for that? Because of the returns that they manage to generate. You see it in our LNG business with the shipping that we have. You now see it as we move towards power, and we'll discuss it a little bit later as well, the move towards flex. You'll see it in flexible generation and a move there. But that will allow Mactel to make some core decisions and make sure that she's integrating to ensure that she actually maximizes or gets the benefit from the trading capability. So it's more of the same rather than change, but it's about making it more visible and hoping that you see the visibility of it and we can extract even more value.
Thank you.
Question at the back there, Kelly?
Yeah, hey, Jason Gableman from TD Cowen. You mentioned that if you do M&A, it's likely in integrated gas and upstream, and this is kind of, continuing on a theme that we've heard. But as you think about what U.S. peers have done, where they've kind of done large M&A and upstream to shore up their resource base out beyond the 2020s into the 2030s, and that's clearly a point you're trying to drive home, to what extent is that something you want to accomplish over the next 10 to 15 years? And then tied to that, as you think about your capital framework, the 40 to 50% CFFO to buybacks, if an opportunity arises that makes you test that level, would you consider changing it? Thanks.
Let's break it into two. Let me start with the M&A, and maybe if you want to talk to the financial framework. We were clear, I think, in the sprint that we saw significant value in our own shares, and therefore every dollar was going to be allocated, every marginal dollar was going to more likely be allocated to buybacks. Our share price was depressed, particularly compared to peers, and we didn't feel that using our paper for that purpose was the best approach. And hopefully you've seen us stick to that, despite on a weekly basis a rumor that we were going to go buy someone or buy the. We've been very focused on it. Now, where we are today is I hope we have earned the confidence of our shareholders to be able to make value-based decisions. The great news is with the $20 to $22 billion of capital over the next 3 years, we can deliver 10% plus free cash flow per share growth. That's just doing our thing. That already makes it one of the most compelling stories, I suspect, in our peer group, and that's without doing anything beyond that. It is also true that our integrated gas and our marketing businesses have a very good runway, as we've described, up to the 2040. Upstream has a runway through to 2030 and beyond, but of course we will opportunistically look at a bolt-on, an opportunity to be able to go inorganic if we see something that's accretive, but the bar is very, very high. Right? The bar has to be high because the alternative is to deploy that capital into our buybacks. The final thing I'd say is, one of the slides we used up there around the vision is a very important slide. I shared that with the organization, was it 2-3 weeks ago now. We've now really tried to articulate what is the company that Shell will look like in the future, in 2035. Anything we can do to be able to continue to accelerate the realization of that vision, we will look into. And it has to be matched with a positive contribution to free cash flow per share. Otherwise, what's the point? It is not strategy without value delivery, nor value delivery that's aimlessly going around the place. It is going to have to be the combination. So where does that leave us from a financial framework, Sinead?
In a wonderful place. Because as you know, we've spent the last couple of years shoring up our balance sheet. We did it purposefully. We did it with intent, and we made sure that we end up with a peer-leading balance sheet at the end of the day. I talked about where we are from a debt perspective. We're incredibly low. At the end of 2024, less than 5% gearing without leases in place. So where does that leave us at the moment? It leaves us with a balance sheet that's robust throughout any scenario, whether that's a scenario of M&A, whether it's a scenario with oil prices, etc. It gives us space, and it gives us room compared to others. At the same time, of course, we're driving that share price up, which makes our paper more valuable. But at the heart of all of this is back to creating value for our shareholders. And while you talked about it, the free cash flow per share, but also those distributions, that 40 to 50%. I wouldn't be standing here telling you 40 to 50% if I didn't believe we could do it through the cycle. And that's really what we've been aiming to do. That balance sheet is there for us to lean on if we need to lean on it. But fundamentally, it's about making sure we as a management team drive the free cash flow of this business to give us those options into the future.
Martin.
Yeah, hi, hello, it's Martin Ratz of Morgan Stanley. I've got two questions, if I may. I appreciated a couple of lines in the statement about sort of intending to stay a leading player in global gas and LNG, and it gives good sort of strategic direction of travel, and I think it's a sort of helpful description. I wanted to pick you up on the intent to stay a leading LNG player. And specifically, I wanted to ask you what you think the investments you would need to do to stay there, because clearly the global LNG business is growing. Are you looking for new FIDs? What kind of investments are required to stay at the front? And the other one I wanted to ask you, related to the current situation. Clearly, trading is very important for Shell. It's a major earnings contributor. But also at the moment, we're in a world with tariffs, counter tariffs. You mentioned the archipelago scenario. I had to think back to mountains and oceans. To me, it looked more like mountains and oceans. Maybe it's archipelago. Anyway, it feels like the sort of trade barriers are growing. And look, it's hard to look inside your trading business, but I can imagine that it has some sort of implication, either a tailwind. It could be that perhaps we have more dislocations in the market that your traders can benefit from. Maybe it's a headwind that trading just becomes more difficult as these barriers go up. And I was wondering if you could give us a perspective on how that situation could impact this part of the company.
Martin, when you start to know the names of all of our scenarios in the past, it shows how long you've been covering us. So thank you for that. Let me cover the first one, and then Sinead can talk a bit to where our trading situation is at the moment. You're right, Martin, and this was what I talked about 2 to 3 weeks ago with the organization, was crystallizing that vision, the purpose of the company, what we're trying to do, and what is it all in service of, as well as the how we're going to do it. And it's a big statement to make, to be the world's leading integrated energy company. Right? What does it entail? At the heart of it, and we'll get into some of the details around this, I think it requires courage of conviction. LNG is a great example. We are absolutely convinced in every scenario LNG is going to grow, whether it's driven by the Asian demand growth, whether it is driven by coal to gas switching in general, whether it's the adjacency with renewables to be able to make sure that the grid has the sufficient backup, whether it's the AI boom in the US and beyond. Gas is going to be key, and LNG is going to grow from 13% of the overall gas mix to around 20%. So a real focus. In that space, that courage of conviction means delivering what we have and potentially taking more opportunities as they come. We don't need a lot of inorganic there. It's very clear where we're going. You look at the list of projects we have, and you can see that we can build runway through to the 2040s. In upstream, it does require investment. And again, you'll see later on close to 1 million barrels per day of projects coming on stream to be able to deliver that on a compelling break-even price. And then in our vision to become the most customer-focused energy marketer and trader, that doesn't require massive new capital. It's already factored into the 8 billion that we're going to be putting into downstream and renewables, and that allows us to methodically grow that business to be able to have the resilience and the cash flow support in the future. So what you're hearing today is a vision that organically can deliver a lot of that, with selective opportunities to be able to accelerate, fast-pace it as and when they come. Sinead.
And in terms of the trading capability, I think the important thing here is we're not a pure trading house. We have that linkage into the assets, which means it's a little bit of a different scenario for us than some of the pure trading houses. Because fundamentally, this group of people will produce the flows that our traders can actually use. So whilst, yes, we're seeing a lot of different headlines and different changes and regulations occurring day in, day out at the moment, what it means is they have certainty of supply coming through, and they have the ability to optimize. So they can take those volumes and move them to where they need to be. Volatility is something we like. We've talked about it before. Our trading capability helps us be able to deliver against it. The nature of that volatility is a little bit different at the moment. We're conscious of that. So as an organization, we're taking a little bit of a pause to say, where do we want to play with the volatility and where we don't? That's just at this moment in time. So I wouldn't characterize it as headwinds specifically. What I would say is it allows us to be able to extract the value that we have from the underlying businesses more and focus on that. And the traders are watching that and just taking their positions with focus. As I said, back to those sandboxes we give them, it makes sure that they don't go too far outside of that.
Thank you. Just as a quick process check, Wael and Sinead were clearly eager to get through the presentation, and we finished a bit earlier than anticipated. So we will let's end the Q&A at 10:15.
Okay.
But still stick to the 15-minute break to respect those of our colleagues and investors and others who have joined online. So we'll do that. The question at the front here, Doug.
Thanks, Mohammed. Thank you for the presentation, guys. It's great to see the update. I guess I'm trying to decipher the numbers. It's Doug Leggett from Wolf Research, incidentally. I'm looking at slide 18, and I'm listening to the commentary that, Sinead, you said you could buy back 40%. You think you can buy back 40% of the stock through 2030. You're also using a flat real oil price, which gets us to about $80 by 2030. So my question is, what is the free cash flow growth in absolute terms over that period? And my follow-up, I guess, is that, Wael, you talked about taking tough decisions during the macro cycles. Your balance sheet is in fantastic shape. So I guess my question there would be, are you prepared to lean in the balance sheet to execute your buyback plan?
Second question, absolutely. First question.
That was short. We're going a bit fast with some of these now, and Mohammed's going to point out. So no, indeed, Doug, there's two things. Yeah, so leaning on the balance sheet, I'll just confirm that we created a balance sheet to be able to lean on it. That's exactly what it is. We need to look through quarters. There will be volatility quarter on quarter. You've seen us do it before, where we've ended up continuing to focus in on the buybacks, even though free cash flow had come down in a certain quarter. That's what we do. We look through. In terms of the free cash flow growth, so let's just take a step back and look at it. So the scenario we gave of up to 40%, or some 40% through 2030, you're absolutely right. It was done on flat. It's a scenario. It's just to give a bit of a feel, and it's at these share prices, to be clear. So you keep mispricing us, we'll keep buying back shares. That's really what the message I wanted to give around that. So when you look at our free cash flow per share target, we've talked about 10% CAGR through 2030. Of course, it's not always linear. You'll know that there will be different periods during it. But you know what we're doing at the moment. So even if you just take what we've been doing in the last couple of years, it's really at that 6 to 7% in terms of buybacks. You can see that coming through. So therefore, where do I need to see growth? Where do I need to see growth? I see it in a number of places. I see it in terms of marketing, and we discussed that earlier, in terms of both our mobility and our lubricants business. You see real growth coming through on that. And we'll detail it out a little bit more in the coming period. We see it in terms of our chemicals business. So some of the changes that we're making, whether that's in terms of divesting Singapore when that comes through, or Monaco, and getting it up and running, that shows growth in our cash flows as well. That's ignoring most of the macro, so I'm ignoring those aspects. Power. You look at our power business of where it is now as we move towards flex. There's some growth in there as well. Now, we can detail further numbers later on if you'd like to go through it. Those aspects, and beyond that, if I were to take structural OPEX coming out, if I were to look at trading, which we have not priced in a significant amount, we've got a baseline through our organization, through our numbers here. It is a flat sort of area to be somewhat conservative on it. That gives me the confidence in terms of being able to say, can I easily backstop that 3 to 4% of absolute growth coming through? We've totally ignored, by the way, the LNG side of things as well. Absolutely, I can. And that's without macro or anything else added into it. So I'm pretty confident in terms of that absolute growth coming.
Okay, over here. Paul?
Thanks, Mohammed. Paul Sankey, Independent Research. The part B of my question actually was just asked, which was about the relocation potential requoting of Shell in this building. And I have to say my view has completely changed. And I now think that being the number one stock in the UK, dominant global LNG player, delivering will potentially be a very powerful thing for you. That was the second question, which was about relocating, which was going to follow on from your meeting last week in the White House. And our understanding was that it was a 2.5-hour meeting, that Donald Trump was present for the entire meeting and was engaged. And there was no discussion of oil price nor OPEC for antitrust reasons. But anything that you could say about your perspective on the meeting as Shell would be very helpful to us here. Thank you.
Thanks, Paul. First, it was, of course, a privilege to be in the White House, and the US is a major, major source of our investment dollars. Actually, the highest capital employed sits in the US for us. I think a couple of points. Firstly, really good to be able to see the energy sector back at the top of the agenda. We welcome that support because for far too long, I think, the narrative has ignored some of the basic provision of energy, of which oil and gas continue to be a critical part. So what was very clear was the administration's support, which we very strongly welcome. In addition to that, what became clearer and clearer is the role that Shell is playing here in the US is particularly powerful. And I'll just give you 3 examples. We are the largest operator and producer in the Gulf of America. And it's very clear that the administration is going to go back to much more predictable leasing of lease sales, which is critical. We're building infrastructure that is amongst the lowest cost, lowest carbon intensity molecules anywhere in the world. And the ability to be able to be the largest player following through on that opportunity, I think, is key. And so that was a key element. Secondly, we're the largest LNG off-taker from the US. With the removal of the pause on LNG, and I think a re-acknowledgement that LNG plays a critical role in the energy transition, that again is positioning a company like Shell to do our bit to be able to bring value. And the third bit is what we're doing in particular in our chemical space, in a place like Pennsylvania, bringing jobs, investing in an environment that is advantaged in so many ways, feedstock-wise, the proximity of our customers, and so on and so forth. And so it was pleasing walking out of that meeting and reflecting, is the administration's agenda misaligned with ours in any way? And saying, actually, in so many different areas, there's very strong alignment, and we're very proud to do our bit as well to be able to bring affordable energy to the folks here in the US and beyond. Indeed, that's a separate topic. Thanks, Paul.
All right, so we've got about 4 minutes or so left, so why don't we make this the final question, and then after this we'll take a 15-minute break. For those joining online, please stay connected, as we will make sure we're here sharply at that point. Maybe Matt at the front here.
Thanks. Matt Lofting at JP Morgan. You've referenced several times the point, Wael, on longevity and clearly extending the free cash flow per share growth objective to 30 speaks to that. I wonder if you can just put perhaps more of an industrial or resource-based slant onto how Shell has looked at the 20 to 22 capex frame and some of the analytics that you've assessed in terms of being confident and having conviction that that's a sufficient level of spend to sustain the business through 2030. And then second, when you talk about being the most customer-focused marketer in the industry, can you just talk about how Shell operationalizes that viewpoint and perhaps where the competitive edge around that is, given that I'm sure several of Shell's peers would aspire to the same thing. Thank you.
Thank you very much, Matt. Let me take the second one and invite Sinead to reflect on the first one. I think, and I touched on it in the speech, the moats, if I could use that word, the moats that we have built are very difficult to replicate. We're talking about not just selling to the customer, but the arteries that deliver energy, whether it's molecules or electrons to the customers. The strength of that part of our business is the bread and butter pipelines. It's the storage terminals. It's the access into the airports to be able to supply 20% of SAF to North America and to Europe. It's our globally leading LNG bunkering facility, of which we have 12 ships delivering LNG to our customers all around the world. Those elements put together allow us to play across that entire value chain from point source of production through to those infrastructure control points, into relationships that we have built with our customers, with a brand that is recognized, with the best example. People say to me, well, you talk about a $50 billion worth brand. What does that mean? Put aside the number. What it means is when we have typically acquired a retail site and rebranded it to Shell, the volume increase, and David Bunch is here, who runs our mobility business. Just ask him about some of the numbers that we get to by rebranding. It's how do we leverage that in every part of that energy value chain? And those are the elements we're looking to continue to hone. It is an asset right. I'm very deliberate in those words. Asset right rather than an asset light or an asset heavy. It's an asset right investment to be able to continue to build those control points for the energy system of today and to pre-build for the energy system of the future, and making sure that we continue to play through the power of our marketing businesses and the power of our trading capability. To really own that space is something which we are very deliberate in pursuit of.
And Matt, on the capital frame, let's take a little bit of a step back on this. So first and foremost, my focus is on just the given, delivering the dividend and delivering that progressive dividend. So that's a given. Then next, it's about, as you say, making sure not only do I maintain the current business, but actually give it enough to grow where it needs to grow. After that, of course, then I have the capital allocation decision of either buybacks or maintaining the balance sheet. We've just discussed the balance sheet is in a great position, hence the preferential buybacks. So ultimately, what I've got is a decision around, are we putting more towards capital investment, or are we putting more towards buyback? And that healthy tension is there across the organization because they know there's always an alternative. But it does mean that we are not short of capital. We're not having to constrain ourselves. That's definitely not the situation. What we see with the 20 to 22 is, in effect, what have we done? We have looked at basically, if you look at the reductions, remember from 25 to 28, if you go back a few years, the money has come out of inorganic in downstream and renewables. That's where the money has come out. And why are we comfortable with that? Well, number one, it's about we've spent a lot there, and we now need to get the value out of those businesses, and we're very much focused on that, and you'll see it as we discuss the ROACE improvements, etc., on that. Secondly, it's about the fact that we've got higher returning businesses elsewhere for now. And it's about, therefore, making sure that we protect and actually sustain and grow our upstream and integrated gas businesses. So when you look at the 12 to 14 billion of capex that we're putting in there, Matt, I'm really comfortable that we have enough to not only sustain, but actually to allow for growth. And actually in those numbers is, in all of our numbers, we've got about 1 to 2 billion of inorganic coming through. And you actually see that we've just done Ursa, of course, a deal on Ursa where we increased our percentages, and there's a number of others, Kaikias and stuff as well. So from back to where Wael put our strategy, he talked about us, sustaining material liquids. We've got the capital to do that. We talked about maintaining our position and growing our position in LNG. We've got the room to do that, and we've got a backstop of projects that lets us get there, which we'll discuss shortly. And then back to that core business in downstream and renewables. Marketing has invested heavily. It's got enough now to do the runway and actually improve the returns on that. You've got our chemicals business, which Machteld is thinking through just how to position that, really doing self-help, etc., but less about growth. There's a small element in there. And then, of course, power is about reallocation of capital. And that's the focus here. This is about reallocation of capital across Shell, not reducing it fundamentally.